What's going on, everyone? My name's Obi and welcome back to the Courtside Financial Podcast, the podcast where we talk about business and technology. Now, while everyone's obsessing over delivery numbers, we're going to be examining three massive shifts that are really affecting the EV space today. So everybody stay tuned. It's going to be a super interesting episode. We got NIO's Onvo making unprecedented customer moves. Ford, American company, literally betting on Chinese technology to survive. And here's the kicker: extended range vehicles are hitting a wall that not many saw coming. NIO did. Stick around because by the end of this episode, you'll understand why we might be witnessing what could be a massive shakeout for the EV market. Let's start with what happened just yesterday, which tells us way more about market dynamics than a delivery report. Onvo, that's NIO's mass market sub-brand, just announced they're compensating customers if delivery waits exceed 4 weeks. Now, before you think, oh great, another delay story, hold up, because this is actually brilliant market intelligence. Here's what's happening. The L90, their flagship large SUV, launched July 31st and has an 8 to 10 week wait time. Now, the L60, the midsize SUV, that's got a 4 to 6 week wait time. And Onvo is saying, we'll pay you 50 Ren, about $7 for every day you gotta wait beyond 28 days. Now, some people might see this as weakness. I see it as strength disguised as customer service. Think about it. They delivered 4,000 L90s in just 2 weeks since August 1st. That's the launch date. That's not a production problem. That's a demand explosion that they're managing. But here's the deeper insight. This move tells us that Onvo's prioritizing customer retention over short-term margins. In China's hyper-competitive EV market, losing a customer purely because of wait times, it's almost like a permanent death. Paying 350 Ren per customer who waits an extra week, that's peanuts compared to losing them to BYD or Tesla. The L90 already hit second place in the weekly SUV sales, 2,093 insurance registrations in the week of August 4th to 10th, only behind the Huawei-backed NIO M8 with 36,090 units. And remember, the M8 only comes in extended range format. Their pure electric version launches this month. This is NIO playing the long game, essentially buying customers' loyalty while ramping up production. Classic moves from a company that understands brand building in China. Now, if you want to see pure desperation, look at Ford. August 11th, Jim Farley basically admitted that the American EV industry is getting schooled by the Chinese EV industry, pointing to companies like BYD. Ford just announced that they're using Chinese technology from CATL to build $30,000 vehicles. Let that sink in. America's largest automaker is relying on Chinese technology to compete with Chinese technology and competitors. Here's the brutal honest truth. Ford's EV business has lost money for 3 consecutive years. They're investing $3 billion in a plant using cattle lithium iron phosphate technology, and this is the key point here because it's a lot cheaper than the ternary batteries that they were using with their Korean partners. But here's the kicker: Republican lawmakers called this out as being too cozy with China. Ford had to halt construction in September 2023, then argue that their wholly owned subsidiary makes these batteries made in the USA. Even the Trump administration decided to continue this project. That's how desperate the situation is. Ford CEO Sherry House said something desperate in July. If we reduce some EV production in the US, it will likely be relocated to other regions like Europe. Translation: Trump's policies meant to revitalize US auto are actually pushing EV production overseas. Meanwhile, the broader US market is only 8% of global new car sales in 2024. The Trump administration killed EV tax credits at the end of September. Mercedes-Benz stopped US EV sales on September 1st. Honda halted large EV development plans in North America as well. So the irony is delicious. Policies meant to counter China are making US automakers more dependent on China, and they're actually forcing production out of America. Now here's where things get really interesting, and this connects directly to NIO's strategic positioning. Extended range vehicles, that's EVs with gas generators as a backup, they're having a moment of truth in China. July numbers tell the story better than words ever could. Pure EVs up 24.5% year over year. Plug-in hybrids flat, but extended range down 10.4%. For context, companies like Li Auto and Huawei's Wenji, they built empires on extended range vehicles. XPeng, they just entered this space, but NIO, they've always stayed pure electric. And this data suggests that for right now, they've made the right call. Here's what's happening. Extended range was supposed to solve for range anxiety, but consumers are realizing that these vehicles now have massive batteries anyway. The new trend is ultra fast charging plus larger batteries plus long range. Some extended range vehicles now have 450 plus kilometers in electric range only. So Li Bin, NIO CEO, nailed it in a recent interview. If extended range batteries are getting this big, why not just buy pure electric? He's got a point. Why carry hundreds of kilograms of generator equipment you'll use once or twice a year? The mid to high end extended range vehicle market is getting crowded. There are at least 15 extended range vehicles dropping this year alone, but the market's just not expanding proportionally. Li Auto's deliveries dropped from 50,000 last year to 30,000. That's a dangerous signal. Meanwhile, luxury cars in China dropped 20% year over year in July. Extended range is becoming a higher end configuration that fewer people can afford. So what does this all mean for the broader market? First, NIO's pure electric strategy looks increasingly validated. While competitors are dealing with the weight and complexity of dual powertrain, NIO's focusing on what they do best. Pure electric premium cars with battery swapping infrastructure. Their 2,400 plus battery swapping stations, those are the answer to range anxiety without the compromise of carrying generator equipment. Second, we're seeing a bifurcation in the global EV market. Chinese companies are advancing rapidly with cost advantages and technical innovation. Western automakers are either partnering with Chinese companies or they're falling behind. Ford's CATL partnership, it's not weakness, people, it's survival. Third, the extended range boom, it might be dying before it even ever truly began. The technology route that was supposed to dominate is hitting economic and practical limits. Pure electric and plug-in hybrids, they're winning in the volume game. For NIO specifically, this validates their long-term vision. They never chased the extended range trend. Instead, they doubled down on premium pure electric vehicles and infrastructure building while we're seeing others pivot and scramble. NIO's been consistent. Look, I'm bullish on NIO, but I try to call it like I see it. These stories aren't just about individual companies, they're about massive strategic shifts that we're seeing happening in real time. The EV market's consolidating around clear winners and losers. Companies consistent with vision, great technology, and smart positioning are the companies that are going to thrive. Companies chasing trends, making desperate partnerships, or entering oversaturated segments, they will inevitably struggle. Onvo's compensation strategy shows confidence in demand and commitment to their consumers' delivery experience. Ford's Chinese partnership shows just how quickly market leadership can shift. The extended range slowdown shows that this market is very dynamic and trends can change very quickly on the turn of a dime. So for investors, I think that the lesson here is clear. In a rapidly evolving market, consistency and strategic clarity matter much more than chasing the trends that may or may not be fickle. Anyways, that's a wrap for today's episode of the Courtside Financial Podcast. I hope you guys found this episode useful, valuable, at the very least entertaining. If you found it to be any of those things, hit the subscribe button, leave a comment down below, click the notification bell icon. We'll see you in the next episode of the Courtside Financial Podcast. This is Obi signing off. Thanks for watching. Goodbye.